Good news. Everybody likes hearing good news. As a banker, I like giving good news, and I'm sure as doctors, you like both receiving and giving good news as well. And the market's been giving us a lot of good news over the last couple of years. Before talking about the ophthalmology publicly traded market specifically, I think it's helpful to take a very brief look at the markets globally. And what we can see here is actually pretty powerful. A synchronous expansion of the global economy coupled with low interest rates and accommodative monetary policy has really enhanced the returns of a variety of asset classes. And this move from bottom right to top left, you can see returns improving, but importantly, volatility declining. Generally, markets are up around 16%, and volatility has been down around 50%. This obviously bodes very well for the equity markets. It's been a story of earnings with the election last year. It was a promise of good earnings with pro-business type policies, but really followed through with the actual deliverance of positive earnings. First quarter was up 15% year over year, second quarter around 12 or 13%, and the third quarter so far growing at a very, very good clip. And all along, the equity markets performing in line with that earnings growth around 13, 14%. And I would mention today started off pretty poorly, and the market had every reason to trade down, but bounced back and really showed the resiliency of this bull market that we're in right now. When you go, but this is an interesting chart. It looks at basically post-World War II, a log scale of the S&P, and you can pretty much see that the market moves in a four-year type rhythm. Every 4 years, it hits a top, and same likewise bottoms out every 4 years, with the exception of the two areas shaded in green. Those were periods of expansion that lasted longer than the 4 years, and understandably followed by a period that contracted longer than your typical contraction. And if you assume that the recent cycle started at the beginning of 2016, where we saw a significant sell-off in equities, we're about halfway through this current 4-year cycle if you buy into this theory. And if you look at how we've done year to date, or this period to date, we're tracking about halfway in terms of return. So another 2 years is very likely here if you believe in this 4-year theory. Okay. It's not turning. Oh, there it is. Okay, we're on a little bit of delay. But all bull markets climb a wall of worry. We have a lot of worry here. Asset bubble is certainly a notion that we're concerned about. Asset prices as a function of net worth are at, as you can tell, all-time highs. And on the right, we can see the PE ratio at roughly 32 times right now is almost twice the historical average. When adjusted for growth, it's still valued fairly, but nonetheless shows the importance of the underlying earnings to the market's health. As it relates specifically to ophthalmology, pretty much for the last couple of years, the index has underperformed that of the broader markets. It's been a bit more volatile. You can see that it's been almost twice as volatile as the life science index, and about slightly more volatile than the broader market. Most of the performance was lost in the early part of 2016, attributing to this period of volatility. But what I will say is volatility can be your friend if you have good news. And what's interesting here is that good news in the ophthalmology sector, defined as phase 2 and phase 3 data, has generated better returns in other therapeutic areas. There's a variety of reasons for that. Don't have all the time to go into it. I think a big part of it, of course, is clinical data tends to be very interpretable, very, I think, prescient about future clinical trial success as well as commercialization. And I think investors like that, and they also, there's not many publicly traded ophthalmology companies, so fewer companies to spread investor dollars over. So this is a pretty powerful dynamic. In terms of exits, M&A continues to be the primary mode of exit. I would add, in addition to John's comments, of all the transactions listed on the top, all but 3 were for private companies. So private companies tend to be acquired very, very frequently, and of course, the derivative of that is you see fewer and fewer IPOs, although we saw one today, but for the most part, M&A is much more dominant than IPOs. For the companies that can go public, they tend to be a bit broader in their platform, have more product opportunities. You can see that they trade very well. From a biopharma perspective, they're leading the other sectors in terms of performance, and from med tech, very close to the top as well. And again, I think this underscores, the scarcity value that you see from the pure play ophthalmology companies. So a positive trend that we've seen in place for a number of years and expect it to continue. In terms of the M&A valuations, we are unfortunately at the bottom of the pack. I wouldn't be too concerned about that. I think that's a function, again, of private companies being earlier in their life cycle and therefore generating less of an M&A value, but relative to the invested capital to get to that point, still create very, very favorable ROIs. And then finally, this is sort of an outlook. All the companies on this page have meaningful events coming up. Of course, the higher you are on the top, the more powerful it is. The market cap on this page is about $130 billion, which represents just under 70% of all the market cap that's tied to ophthalmology. And all these companies have events coming up in the next year or so. And when you couple this with what I mentioned earlier about ophthalmology stocks performing very well in response to good news, we think this creates a very good foundation for continued interest in the publicly traded ophthalmology sector. So with that, I'll conclude my remarks, and thank you very much.